is the banking space shaping up? What are the factors at play? And with respect to the big consumption boost, is there anything that the banking space can also benefit from, especially from the retail side? And we have Mr. Pranav Gundlapalle, who's the senior research analyst at Bernstein, joining us on the show right now. Hi Pranav, morning. Good to be speaking with you. And Pranav, lots been happening within the banking space. We have been talking about the slower credit growth, how there was a stress in select pockets. But as of now, help us firstly understand where are the things shaping up and standing at this point in time. And more importantly, what sort of a recovery are we penciling in for the second half?
Good morning. So I think it's fair to say that the banks are close to the bottom, both in terms of growth and margins. On the growth front, we've seen a sharp slowdown in growth. The sector was growing at almost 16% year on year around May of last year, is now down to about 10%. And on the margins front, I think with the rate cut impact likely to be visible by next quarter, we are close to the bottom on the margin front as well. So both on the growth in margins, we expect improvements to kick in for the second half. And on the growth side specifically, we expect the credit growth to inch up from the current 10% to almost about 12 to 13% by end of FY26. So a modest improvement is what we expect as all the initiatives to boost consumption will at least stabilize the credit growth on that front and lead to a near 12% growth for the banking sector.
All right. But Pranav, the other fact is that though we will deep dive more into which within the public and the private sector is expected to win, but before that, this credit growth pickup that you are also penciling in, especially in the second half, expected to go in that double-digit mark. Which pockets do you believe will help this credit growth? And with respect to the retail portfolio, because this is whole GST reset that is expected from 22nd of September, will that give some bit of a push to the credit growth, do you believe?
So we think the impact of retail specifically will be limited. At least the impact of GST cuts will be limited. In fact, we might actually see a slight negative impact immediately after the GST cut, because for a lot of segments, the financing value is based on the final purchase price, and then that actually gets lowered. So not an immediate beneficiary of the GST cuts, but improving consumer wallets should drive a pickup in demand, at least towards the later part of the second half. So yes, a positive, but not an immediate beneficiary of the GST rate cuts. And on the segments that will drive the recovery from 10 to 12%, we think a recovery in growth of banking credit to NBFCs, a pickup in mortgages thanks to the reduced interest rates, should both be sufficient to take the growth rate from about 10% today to about 12%. On the unsecured credit or the consumption credit, we think the growth will be modest or will remain modest. We don't see a very sharp recovery there. It's going to remain much lower than the levels we saw in the last 2 years. But still, a nice 2 percentage points improvement in growth is what we expect over the next 6 months.
But Pranav, given the fact that we are in the rate cut cycle and in general, we do see the bank's margins witness some bit of a compression. But help us understand that with sort of a credit growth uptick, what could be the likely implication on the margins? Because banks are yet to pass on that 50 basis point cut. And what exactly are you penciling in with respect to the margins? Are we in to see some bit of a recovery over there as well, especially in the second half?
We would see a bottoming out of the margins in the next quarter, which is the end of 2Q, is when we would see the entire 100 bips of rate cut getting priced on the lending side, or the loan yields will have the entire impact of 100 bips priced in. So you take the bulk of the impact. On the deposit side, only a part of the rate cut would be priced in. So over the next few quarters, the deposits will start getting repriced lower, and that will lead to a sequential improvement in margins. So we expect about 15 to 20 bips dip on a full year basis for FY26 versus FY25. But the bottom on the net interest margin basis should occur by second or third quarter. And from there on, we should see a sequential improvement. Now, even if we have another rate cut sometime in early next calendar year, there should be enough benefit from repricing of deposits that will allow banks to see sequential improvement and not another dip on the net interest margins. So overall, close to the bottom and a gradual recovery from the second half onwards.
Pranav, hi, morning. This is Nehi also joining in the conversation. Now, if you take a look at how the private sector versus the public sector banks have been faring, you are more optimistic on the public sector banks doing better going ahead. What's driving this optimism? And do you see a trend emerging that now perhaps the next round of positivity in the overall banking space could be led by the PSUs?
Just to clarify, I expect the public sector banks to grow faster on the loan front, but not necessarily do well on a stock front. What we have seen in the last 12 months is aggressive growth from the public sector banks, which now exceeds the growth of the private sector banks, driven largely by aggressive pricing. If you look at both on the deposits as well as the loan side, the public sector banks are pricing very aggressively. So, for example, on the term deposit front, you now have public sector banks which are pricing almost 30-40 bips higher than the private sector banks. And similarly, on the loan side, in several segments like mortgages, you have the public sector banks pricing significantly lower than the private sector banks and taking a larger part of the incremental market share. Now, this is not great news for the private sector banks, but even for the public sector banks, this is not great news because growth is coming at the expense of margins, which would not be rewarded by the banks, by investors. Right? So, in a scenario where this sort of pricing aggression continues, we might just see that the entire sector suffers from weaker earnings growth. That to us is the biggest risk in the sector today. Whereas a more benign scenario is one where the pricing remains protected and we have healthy earnings growth across the board. So we still prefer the private sector banks as an investment case at this point, while we continue to watch the actions of the public sector banks to assess what kind of earnings growth the private sector banks could see over the next couple of years.
With respect to valuations, Pranav, because some of the factors that you just highlighted, the private sector banks used to trade at a premium valuation versus the public sector banks. If this is the scenario, and for at least now what we are getting to see that the public sector banks are more aggressive versus the private players, do you believe that the valuation difference is likely to compress? Is that a risk as well?
I think the valuation risk there is a valuation risk for the private sector banks if this sort of aggression continues. But a big re-rating for the public sector bank is unlikely until we see a sustainable level of growth and margins emerge for the public sector banks. I think the big question is for the public sector banks, they are still enjoying the benefits of ultra low credit costs and the treasury gains. Once those factors go away, we'll wait to see what sort of an ROA they settle at and also what sort of growth they can manage while delivering that ROA. So it's still a bit of wait and watch for the public sector banks. And for the private sector banks, the valuation has seen a fair amount of correction over the last few years. And yes, there is a risk if this sort of aggression continues for the next couple of years or so.
Okay, and on your outlook going ahead, quarter two seems to be a challenging quarter for weaker NIMs, higher credit costs and muted loan growth. But by when are you expecting this tide to turn? How much of a waiting period should we pencil in before these banks, start improving their financials and it all starts looking very optimistic?
On the margins front, we expect a recovery by the third or fourth quarter. So you're going to wait for another couple of quarters at best. On the loan growth front is where it's a bit more uncertain. I think it all depends on how quickly the consumer growth picks up, the growth of NBFC credit or bank credit to NBFC picks up. But even there, we expect a recovery by the fourth quarter. So we're looking at a couple of quarters of waiting period. But the cheap valuations gives you enough reasons to hold on to the banks. I think while you have a wait for growth across many sectors, what works in the bank's favor is a much cheaper valuation relative to the broader market.
All right, Pranav, with this, we let you go on that. Thank you so much for taking the time out and helping us understand what's really happening with respect to the banking space and what's the outlook going ahead. Thank you so much.